about some credit cards.
Thank God, 'cause I never understood how this works.
Well, this might help.
I'm like, there's a limit. Why not just spend all of it? Like, why do you have to limit?
I get why you shouldn't spend a lot on your credit cards, but I don't understand the concept of like buying things and then
Just borrowing money from somebody.
Well, use like a credit card to like buy a drink.
Buy a drink? I
Yeah.
don't know how much sense that makes.
Right, because like you always get asked like credit or debit.
Well, that's it. All right. So, opening the lesson again, so the debit cards now, they didn't used to be, actually, you probably notice there's like a Visa or MasterCard logo on them, right? So it used to be that in most card swipers, a lot of them didn't take a debit card. It was one of the major credit cards, like their program for, MasterCard, American Express, Visa, and all that, right? So the debit cards didn't really work in the swipers a lot. Like you had to go to the ATM to cash out and pay it, right? Some of them did. But then some years ago, most of the banks switched over to making the debit card compatible with either Visa. You'll see a Visa or MasterCard logo on it. And so now you swipe it, and then you can select whether you want to run it as a debit or a credit. It does not matter. It's like I almost don't understand why you have the question, but sometimes if you just run it as a debit, all you do is put the pin in, you're done. But if you choose credit, then you sign the receipt, give it back to them. It doesn't really. It works the same way. That just makes it so they can be compatible with those machines.
Are you supposed to swipe or insert a debit card?
If you have the smart chip on it, then you can insert it.
Wow.
You'll see on the it's more secure that way. A lot of there's devices out there.
some things won't let you.
Yeah, right. If you have the chip on there, it's to protect against your. People can actually scan their swipe on certain devices, right? Or they plant them on a swiper, like an ATM or gas pump or
Where
something.
can I get one of those?
Right, from some of the dark web. For scientific purposes, probably. Okay. All right. So credit cards are a form of debt. It's a form of borrowing money, right? And we've been talking about regular loans, right? Where you borrow one single amount of principal, and you have a payment that's the same throughout the life of the loan. And I don't remember if I used the term, but those are called installment loans. Okay. Those are called installment loans or installment credit. A credit card, as you use it and pay it down and use it and pay it down, the balance of the principal goes up and down, right? Agree with that? On the credit card, you're borrowing a certain amount, up to a limit, you said, right? Why is there a limit, you were asking? Because the banks will look at you and your income and decide how much do we want to risk this person, tapping their card out at, and we know if maybe we'll stop her at $1,000 and not $10,000 like her parents, because her parents make more money and have better, credit history, and they're more likely to be able to pay off a $10,000. They want to, right? But credit cards are not free money. It's not like, I can get this stuff for free with my credit card. No.
It's not a credit card with like a fake identity and just spend it all.
Well, that's illegal. That's a felony.
That's unbelievable.
Yes, that's a felony. And they have certain protections, right, against these things getting stolen. We'll get into that. So a credit card is not an installment loan. It's what's called revolving credit. It's a revolving line of credit.
How do you pay off the credit card? Do you do that monthly, or is it take it out of your account?
It could go either way.
'Cause I forget.
Okay. And that's part of what, helps banks determine whether you're a good or bad credit risk. Hey, this person forgets to pay their bills, right? And so therefore, no one will your credit score to do that. But the way things are now, you set up an account online with your credit card, and you get reminders all the time. I get constant alerts on my phone about a payment being due for this or that. It's kind of hard to forget these days. So it's a revolving means like the principal isn't the same all the time. Principal goes up and you pay it down. Okay. and it's unsecured. It's an unsecured loan, basically. What does that mean? Versus, say, like a car loan. No? So a car loan is a secured loan. The bank secures a loan with collateral, the car, right?
You don't have to pay it all off.
Hmm?
You don't have to pay like the whole $10,000 off. That's what we're saying.
Well, sometimes you have to keep making payments, right? So unsecured means there's no collateral. Okay, like a car. So what do you think that means if the bank is giving you a credit card, they're giving you a loan with no collateral? What do you think that means for the risk on the bank side? How is it, so would a car loan or a credit card be riskier for a bank to issue?
Oh, car, because the car is an actual car. And that's just
Will that be less risky?
Yeah.
Because they have collateral, they have something of value that can come and possess with you if you don't pay, right?
Yeah, but a car is just a car.
Oh, card does.
Yeah,
Car. Oh, that was a
is
car.
more risky.
Oh, yeah, so there's no collateral, right? So a credit card is basically just, we're gonna loan you money based on your good looks, right? Not exactly your credit and all that, your income. But there's nothing they can do to come and get at you, right? They can't take anything, right? I've heard stories of people that get into a lot of credit card debt and they can't pay it, right? And they'll get these phone calls from debt collectors. They get pretty nasty sometimes, right? And they'll say, you know, well, we're gonna end up repossessing your car and your house and all that. And no, they can't do that because it's an unsecured loan. If they were going to be able to repossess any of your property for a loan, that has to be spelled out in the agreement of the loan, the credit card, before you start. If that's not in that agreement, then they can't do it. Okay? So if you ever get threatened with that for a credit card, just try to chuckle and say, I'll talk to you later, you know? Leave me alone. Huh? But again, they have all the risk mitigation techniques. Okay? The mafia. So if this is a riskier loan for a bank than a secured loan, what do you think about the interest rates?
Higher.
Okay, so it's higher risk. Okay, and so they need a higher expected rate of return, right? So higher interest rate. Higher rates. You know, like car loans right now, probably somewhere around 3 point something %. A credit card, unsecured, would be like 15 to 18% still. So pretty significant, right? So you want to, and you what? It'd be at least 18. You have to be the legal age to enter any agreement by law. The age of majority is 18. Well, what you could do, well, okay, some people do this. They will get a credit card in their name, and you can attach someone else's name to it, right? As long as they're not the one, so they can attach their child's name to it. And while the parents are using that card, their child is actually building up a credit report, right? Because their name is also on that card. That makes sense. But the bank didn't actually issue the child the card.
You're at 5 years old, you bought your first car, paid it off.
5-year-old bought his first car, right? He waddled into the bank with his diaper on, the best diaper. You want to look good, presentable,
Yeah.
right? His nicest bed, you know. They got him sitting down at the desk, gave him a sippy cup, you know.
Just babble.
Something like that. Anyway, so it's a higher risk. And so therefore the interest rates are much higher, okay? And all of that is spelled out, by the way. I talked about in the video yesterday, the TIL, truth in lending. Anytime you take out a loan, whether it's a car loan, mortgage, credit card, there's a TIL statement, T-I-L, truth in lending statement, right? It spells out the interest, the terms, the penalty for late payments, penalty for paying off early, all that stuff, right? The total finance charges that we've been calculating in the last section, okay? All the details of the loan, everything's spelled out, right? So if they could come and take your car, you pay your credit card, that would have to be in that TIL, right? Huh? That will actually be theft. because they have no legal right to take see-through property for something you didn't agree to.
Something that's-
Now, they could at some point, if it was a big enough debt and they thought it was worth their while, they could go to the courts and sue you and get a judgment for that money, and then the courts could, have your wages assigned, they call it, right? If you, like, talk to your employer, said, we've decreed that yields this much, and we need you to give this credit card company $150 out of every one of his paychecks. Right? But that's not easy to do. That's a rare thing, and it's a lot of legal, it costs a lot of money, attorneys involved. As soon as you declare bankruptcy, the creditors can't even call you anymore. When they call to collect, as soon as you say, I'm in the process of filing bankruptcy, they have to stop calling by law, right, and leave you alone.
What if you just said you were?
Well, they have to stop, and then they will verify that, see.
And see what the meters.
Can you file bankruptcy if you have money?
Can you file bankruptcy if what?
If you have money, like you're using a lot of money? We just give
Yeah,
you money.
yeah.
It seems to me the
Maybe you have money, but, you end up with too much debt, or your business,
What if you have no debt and you just want them to leave you alone?
if you have no debt, then why are they calling you?
What if you have like a little bit of debt?
Yeah, well, bankruptcy costs money to do. You've got an attorney, and to go to court fees and attorney fees. So you might want to make it worth your while. If you only have $100 balance on all your debt altogether, and it costs $1,000 for a bankruptcy attorney. You see what I mean?
I truly
But if you stay in bankruptcy, if you go into more debt, then they can't call you once you got the debt.
I'll leave the country.
Yeah, I'll leave the country.
Well, if you go into bankruptcy, you end up canceling your debt out into a card throw away, right? So the man, you don't have it
I
anymore.
thought it was just like a label.
There's that too.
I
Yeah.
only learned anything about
Now, though they have higher interest rates, right? There's billing cycles. There's usually like a 1-month billing cycle. Some are 28 days, some are 30 days. Let's say you charge something on your card, right, during the billing cycle, and you turn around before that billing cycle is over and pay off that whole charge, then there's no interest charged. Okay? Well, you used to have to, what they would do is, before the internet, they would send you a bill in the mail with an envelope, and another envelope enclosed in that, and you write the check, put it in that envelope that they gave you, and send that off to them with the bill in the mail. Now you just go online, so if you have a Capital One account, credit card, you create an account on Capital One, and it shows you this is your credit card balance, this is your payment that's due on June 5th, and you click on make payment, and make the payment. Right? So this is important. There's no interest. Right? If the balance is paid in full each cycle. Whoops. If balance paid in full each cycle. Which, by the way, is a kind of a decent way to start building up your credit, right? Let's say you got Jonathan has one too. He's got a credit card with $1,000 limit, and the way I explained to him to do is establish your credit by doing the following. If you go to the store, put gas in your car, you would normally use your debit card, right? That'll come out of your checking account. Use that credit card, right? But don't use any more than you normally spend in your debit card, right? Use that credit card, pay for your gas or whatever it is with that, and then in a couple of days go online and pay that off with your debit card, right? So you're not out any more than you normally would, but what happened is you've got some movement and activity, right? You've got borrowed money, paid money, borrowed money, paid money. That starts going on your credit report. And as long as you pay it back off before that cycle ends, the billing cycle, there's no interest, so it costs you nothing. Does that make sense? Okay. So there's credit cards, and there's also things called charge cards. They're a little more rare. Huh? No. So charge cards, the entire balance has to be paid off each month. Okay? It's like a requirement, so a little bit different. Entire balance And not just some minimum monthly payment, the entire balance must be paid each month. So it's almost like an accounts payable if you have a business, right? Who might use a charge? I mean, some individuals use charge cards. American Express is a charge card. So let's say you own a business and you need to supply yourself with inventory, put things on the shelves, right? So this is like short term. So I'll use this charge card, right? I'll get my inventory with the charge card. I'll pay it off the end of the month. It's kind of like I said, accounts payable, where a lot of times the supplier you go to for inventory will allow you 30 days to pay for the inventory they deliver to you, right? So it's kind of like that. You can use, if they have that available, you can use that, or you can use what's called a charge card. Yep, you could, but I think the interest rates are lower on this, right? So it costs you less because you are presumably paying it off. So they have some advantages for business. Okay? Now a debit card, on the other hand, you know what that is, right? That's true. When you pay with a debit card, where does that money come from? Are you borrowing it? Yes, money is drawn from your checking or savings account. So money drawn from checking or savings. Okay. Now there's some other terms here, like on page 180. This is important. So if you go over to page 180, they reference the Truth in Lending Act again. And that, in addition to requiring lenders to spell out all the details in a till statement, it also offers you some protections. Say, for example, if your credit card is lost or stolen, or your debit card is lost or stolen, that kind of thing. Okay. So by law, if your credit card is lost or stolen, the actual card itself, right? If you look over on page 180, you want to report that to the company as soon as possible, right? And as soon as you have reported it stolen or lost to the credit card company, you are not responsible for any charges that go on after that. Okay? They'll close a card and somebody's like at the store, you know, buying a new computer with your credit card, it'll get declined if you just reported it. Or if they don't get it shut down in time, you're not responsible for the $1,000 computer. Okay? And I'm not going to write all this down. I'll just say see protections, pages to P 180 to 181. Okay? So you would have a maximum, like whatever got charged in your car after you reported it, you would have a maximum liability of $50. Okay? That's all you'd be on the hook for by law. Okay? If you report it immediately. Now, if your number is stolen, right? I've had this happen to me before. Credit card number leak. People get on the interweb and somehow get your number. They breach certain sites and get a bunch of account numbers, right? Then you're not responsible for any of it because then it's like you wouldn't even know that your card was stolen, right? Physically. And so by law, you're not responsible for any of those charges. But if your card is stolen, you can be responsible for up to $50. Whether they charge $10,000 on it, you're only going to be on the hook for $50. Now, I will say, I don't know that any credit card company can hold you to that $50, by the way. You know, to stay competitive with the other credit card companies, what benefit would see it then? Like $50 from the other multi-billion-dollar company, you know, so they don't be bothered with that. And so a stolen credit card is not quite as bad as a stolen debit card. Why is that? That's more cash, right? That's like if someone steals your debit card, that's like going into your wallet and taking out your cash physically, right? So that's kind of a different thing. Now the protections are not a little bit different for a stolen debit card. Okay, go to the top of page 181. It's not covered under the TIL Act. It's covered under the Electronic Funds Transfer Act, right? You're not responsible for purchases made, a lost or stolen card, after it's reported stolen or lost. So what happens in, like, by law, if your card is stolen and you don't notice it for 2 weeks, somebody's been racking charges up. But by law, you haven't reported it yet, so you're responsible for those charges that someone else made, right? But not anything after you reported your debit card stolen. And that kind of stinks, right? But most banks now don't even hold to that. In fact, most banks, I know my bank will, if I'm traveling and using my debit card, I've gone down to Hampton, Virginia, and tried to swipe my card to get gas, and it was declined. Because they're on the lookout for this. Like, oh wait, he lives in New York. They know my address, and all those purchases are generally here in this geographic region. So there's one down there. They shut it. They cut it off. Huh? So what you really should do is, like, if you're going to take a trip, call your bank and say, listen, I'm going to be in Florida, for a couple of weeks. You can see the charge there. It's me, otherwise they'll shut it down for you. But then, like, if they do that, then it's just a quick matter of getting on your phone and say, hey, no, that was me that just did that. I'm on a trip. And then they'll put it back, right? But that's good to know, right? Like, if someone had your card and was in another state using it, they're on the ball, shutting it down for you. So anyway, most banks will not hold you to anything. Like, even if I had a debit card stolen a couple of summers ago, just the number, right? And I went on my checking account and see these charges for like a $1.20 for, and another charge, for another little bit, $5.60, right? So if somebody had a card number, it looks like they were like testing it out to see if it's good, And then the next thing I know, some guy charged $700 and another charge for $1,100. And my bank called me. They actually sent me a text. They gave me a phone call. Says, hey, this doesn't look right. We're shutting the card off, right? But in the meantime, the guy charged all that to my account, a couple of grand there, as it turns out. And they refunded all the money back to me. Turns out some guy down in Tijuana, Mexico, had my card number. He was buying tequila shots or something. I don't know what he was saying. But so debit card protections, though, the banks do more than is required by law to do to protect us. You're in pretty good shape there. Check whatever bank you use. Okay, but just be careful with it. Okay, so be familiar with the protections and what your requirements are. Whether you owe $50 or not. Okay, so let's take a look at some examples. And this won't take too long here. Hey, Simone, read us example 1, would you please, dear? Okay. 0 to 50? Well, hold on. Remember, he's only responsible for $50 of charges before he reports it on a credit card. But nothing got charged until after he reported it stolen. So it is how much? $0, right? So it's $0. Because by the till, right, Truth in Lending Act rules, right, reported it lost before it was used. Reported, here, right there. It lost before it was used. All right, so simple enough. All right, let's try the check, Carly. Read that over.
Carrie's credit card was stolen. She didn't realize it for days, at which point she notified the creditor. During that time, someone charged $2,000. How much is Carrie responsible to pay? So before she reported it, right? Someone charged $2,000. It was physically stolen, not just a number on the dark web, right? So how much is she legally responsible for?
So that's her $50. Okay? Even though it was a $2,000 charge before she reported it. But I can tell you, most banks are not even going to hold her to that. Okay? Most banks won't even bother with that much. Okay? All right. Hey, Dylan, let's take a look at example 2. Do a little calculations here.
credit card companies issue a state, therefore APR, be compared to monthly credit rate. The APR is 1.6% for the monthly finance charge.
All right, so I mean, we've done this in the midst of our formulas, right? APR is annual percentage rate, so this is really simple, right? So what do we do? Was it 21.6, right? Whew, that credit card interest, huh?
Yeah.
What do we do to make that a monthly?
5 by 12.
Divided by 12, I think that comes out to 1.8% monthly. That's not hard, is it? I mean, that, like every formula we've used so far. Your credit card has different balances as you go through the month, okay, through the billing cycle. And we can average that out. What's that? We're done with example 2. I'm going to talk about this before I hit example 3. We're going to discuss average daily balance. Okay, so average daily balance is a weighted average of the daily balances during the cycle. You know what weighted averages are, right? Let me write this down. We'll talk about that real quick. So it's a weighted average of daily balances during the cycle. Okay. So weighted average, to be clear on that, you know, like your grade in this class is a weighted average. You know, test quizzes and homework, right? I forget how I had it in here, but let's say tests are 40%, quizzes are 20%, homework's 40%, whatever it was, right? So like you take your test average, since that's 40%, you multiply it by 0.4, and then I take the quiz average, that's 20%. So you take that quiz average, multiply it by 0.2, etc., and then I add all those results up, right? So they're all weighted differently. So your billing cycle, everything balance works just like that. So maybe for 2 days you have a balance of $100, right? And then for 5 days you got a balance of 150, right? So it's 2 times 100 plus 5 times 150, right? And at the end, the average, so you divide by all the number of days, like 30. And that gives you your average daily balance. And that's what the interest, right? So you take that monthly interest rate, wherever the APR is, and multiply your daily balance by that interest, and that's what your monthly interest rate is. So let's take a look at example 3. So Rebecca did not pay last month's credit card bill in full. So basically, like whatever you charge credit card bill, that balance goes into the next month's billing cycle, right? You don't pay it off. So if you have a balance of $200 in July, then that $200 will be in August's billing cycle. Okay? So for 7 days, you owe $456.11, 3 days, $11.70. You can see it right there, right? So find the average daily balance. So we're going to do a weighted average. And we can do it all at once. One big fat smooth calculation here. Okay? So this is example 3. Well, here's what I'm going to do. So $7 at 456.11. So 7 times 456.11. And I think I probably need to write a little smaller because this gets kind of wide. We'll do this. So 7, do it like this. Unbelievable. Yowza. 7 times 456.11, right? Plus, we got what, 3 days at 1177? 3 days, you see how I'm doing this? 60 plus 6 days at 990.08 is the balance for those next 6 days. And then 9 days at 2115.15, so plus 9 times 215.15. And then 5 days at 2309, so plus 5 days at 2309.13. Okay? So we had the weighting part of it. You get how we did that? The number of days times the balance it had that number of days. Now we got to divide it by something to get an average. What are we going to divide it by?
All the days.
So how many days were there? 7 and 3 is 10. Well, let's make it. Sometimes billing cycles are 28, 29, 30, right? So let's just add them up. So 10, 16, right? 25, and this does turn out to be 30. So don't always assume 30, because sometimes they're slightly different. You get me? So add up those number of days. So we divide that by 30, right? Now, of course, when you put all this in your calculator, kids, you're going to want, group. They don't even help you there. You still got a group that you with a fraction button. Okay? And so when you put that all in correctly and carefully, your average daily balance should come out to 1441.60. That's how much your average daily balance is. It looks like, okay, the first 7 days was $450, right? Then it looks like she went out and charged some more, brought it up to 11. Then it looks like she maybe sent in a payment here, reduced it, then charged some more, then charged some more, right? Does that make sense? She's pretty active. Well, I don't know where her max is, where her cap is. Okay? All right. So how do you think you would find the actual finance charge for that average daily balance? So look at example 2. We know and these are all going to be tied together. 21.6% APR, right? And we made it monthly. This is the average daily balance for the month. So what do you think we'll do to find the finance charge? Multiply. Let's go to example 4. Well, okay. Here's the interest rate, the APR on the credit card, right? So examples 2 and 3 and 4 are all tied together, right? And we worked out that comes to 1.8% monthly. Remember that? Okay. Here's the average daily balance for this particular monthly, a month, right? And the 1.8 was the rate we're going to multiply it by, and that will be the interest charge, finance charge, right? And that's what we're doing in example 4. Carly, read example 4.
Rebecca, example 3, pays a finance charge on her average daily balance of that. Her APR is 18%. What is her finance charge for this month?
Oh, I'm sorry. I thought they were using, my mistake. They're not using that 21. I'm sorry. But we are using example 3. So that's 18%. So we need the monthly finance charge, the monthly interest rate, right? How do we turn that 18 into monthly, like back in example 2? That's annual. 12. So we could just do this. Finance charge is going to equal her, what was it, 1441.60? Now, instead of multiplying by 0.18, I'm just going to put it in like this. 0.18 divided by 12. See what I did there? Right? So this is our monthly rate right here. Okay? And when we punch that in, you get a finance charge of $21.62. And then, so that would be the interest charge. And then what the credit card companies do is they'll add a little bit of principal to that to give you a complete full monthly payment so that you start to reduce your principal. All right. One thing that credit card companies used to do, and it's now illegal, is what's called, remember we talked about the amortization table, where the principal gets reduced every time you make a payment. It's generally advantageous for a credit card company to keep receiving payments and not having the balance go down. Because why would that be? If your principal doesn't go down, you have to keep making payments, and how does that benefit the credit card company? You have to keep paying them, and paying them, and paying them, and get the money, right? So what they used to do, some of them, the shadier ones, was what was called reverse amortization. So they would calculate your monthly payment such that your principal never got reduced. In fact, sometimes it would increase. So the principal, by the payment that they set as a minimum, would actually increase. And so, in theory, you would be making payments through infinity for a $2,000 credit card.
So you said, right?
What?
So you said?
Yes, and then it would go into probate in your estate, and your children would be responsible for it, right? But that's become, that's illegal now, right? Laws passed that said that reverse amortization is not legal. You must assess a minimum payment that reduces the principal by a certain amount each payment.
Became illegal when people started touching around.
Yeah, well, people ended up with credit card bills that never went away because, you know, they only made the minimum payment. Now, you can make more than the minimum payment, but a lot of people will just make the minimum payment, right? And when they did that, they never reduced their balance. And so the credit card companies had people paying them, you know, infinitely.